अस्सलाम वालेकुम। आप सबको you are getting my voice and am I visible to you? Okay, okay, great. So we are starting. Well, we'll start with the payback period today. We had uh, basics of net present value yesterday. We had basics of IRR yesterday. We discussed annuity. We discussed delayed annuity. We discussed advanced annuity, and we also discussed perpetuity. Today, the another investment appraisal technique is the payback period. And what payback period is? Payback period is actually the time that a project takes for the recovery of its initial investment. That is, say for example, if you have invested 1 lakh US dollars in a project, and each year you are expecting to receive $25,000, how long it will take to cover that initial 1 lakh investment? So it will take 4 years, right? Because each year, if you're going to get 25,000, it will take 4 years to recover $1 lakh. That's called a payback period. So the payback period is actually the time that any project would take to cover the initial investment. Now, this is a very useful technique in appraising a project. So let's discuss the payback, how we calculate the payback. Let's first look at the formula on your screen, the payback period for annuity. When you are going to calculate a payback period for a project that generates constant cash flows every year, the formula for calculating the payback will be the initial investment divided by the annuity. Look at this example. What will be the payback period for a project whose initial investment is $1 lakh? Now, if you invest $1 lakh in a project and you expect this project to generate $25,000 cash inflows every year, what will be the payback period? It's so simple. Initial investment, $1 lakh, and every year you're going to get $25,000. So it will take 4 years to cover this investment. Just give me a minute. Let me see where it is. Yeah, this is the payback period for an annuity project. Now let's discuss the payback for a project that generates uneven cash flows every year. Look at the example on your screen, payback period for a non-annuity project. Alpha Company is considering to invest 25,000 US dollars in a 3 years project, which will generate following cash flows. Year 1, $9,000, 2, $10,000, and year 3, $12,000. And you can see that we are going to get different cash flows every year. If the cost of capital is 10%, calculate the payback period. For the time being, the cost of capital is irrelevant for us, so we'll just ignore it. Now we're gonna calculate the payback period for this project. That how long is it going to take to recover $25,000? Now we can't use the formula that we have used above because we are not going to receive even cash flows every year. So what we are going to do is we'll just prepare this table in which you can clearly see years, cash flows, and CCF. The CCF is actually cumulative cash flow. It's cumulative cash flow. So cumulative cash flow, and how we calculate the cumulative cash flow. At 0 point, we have invested $25,000, so we will have a $25,000 investment stuck in the project. After the end of first year, we will receive $9,000. Out of $25,000, we will receive $9,000, so we will left with $16,000 investment. So from in the second year, at the end of the second year, we will receive further $10,000. Since we have $16,000 still invested in the project, and we have recovered further $10,000, so we will be left with $6,000 cash flow investment. And by the end of the third year, we have received further $12,000, where we were supposed to receive $6,000 and we have received $12,000, so we'll be having a surplus of $6,000. This means that somewhere in year 3 we have recovered our investment. So it's clearly obvious that the project took 2 complete years and some part of the third year. Now, what part of the third year did it take? We were expecting to receive $6,000 in year 3, but we actually received $12,000. If the whole year gave us $12,000, then what part of the year it would have taken to cover just $6,000? Since $6,000 is half of the $12,000, it means it would have taken half of the year. We're assuming that these $12,000 were received evenly throughout the year. So if the whole year has made us cover $12,000, then how long it would have taken to cover just $6,000? So we'll just take this last negative cash flow and we will divide it with the complete cash flow of the year, that is $12,000. So we'll come to know what fraction of the third year it took to cover the whole investment. So 6,000 divided by 12,000, it will give you 0.5, and half of the year. So it took 2.5, that's 2.5 years to cover this investment. So the payback period for this non-annuity project is the payback period for this non-annuity project is 2.5 years. Nimra, I haven't got your question. Can you just explain it further? Are you people getting my voice clear, and are you people getting the pictures clear? Yes, Aisha, you can say half of the year or 6 months. Yes, 2 years and 6 months. Dania, yes, we can say that it's 2 years and 6 months, or we can say it's 2.5 years. Yep. Any other question? Wahab, yes, we can also calculate in months. And if you want to calculate in months, what you have to do is just write this 2 years and this 0.5, multiply this 0.5 with 12. So if you multiply this 0.5 with 12, you will get it in months. So 2 years and 6 months. Noor, at the moment we haven't used cost of capital. In the next slide, I will explain why we didn't use the cost of capital in this example. It's Namshad, it's the negative cash flow of at the end of year 2. It's not the positive 6,000 of year 3. It's the last negative cash inflow. Well, Tabassum, we have we discussed we started investment appraisal and we discussed the basics of investment appraisal yesterday, and we were left with the payback period, and today we are going to start advanced investment appraisal after we are done with the payback period. So should I move ahead? I think we're done with the questions. Okay. Now we have got two problems with this payback period. One problem is that it did not consider the time value of money. So the very first problem with this payback period is that we did not consider the time value of money. We invested $25,000 at 0.0, and the 25,000 that we are going to receive from this project will take 2.5 years. During these 2.5 years, we are also going to pay to our fund providers their return in the shape of dividend and interest. So this payback period has totally ignored the cost of capital. That it has totally ignored the time value of money. During these 2.5 years, we are supposed to pay dividends and interest as well. And that should also be covered from the project. So this payback period has ignored this thing. So we can say that one of the limitations of the payback period is that it ignores time value of money. So we will consider it later on, I will tell you. So this is the first drawback of this payback period. Then we have a second drawback of the payback period, and that is it does not consider cash flows after payback period. We just ignored the positive $6,000 surplus that we received at the end of year 3. We are least concerned about the cash flows that we will receive after the payback period and what it will do to us, what negative impact it is going to put on us. We will, if we choose payback period as our investment appraisal technique, we would prefer projects that have shorter payback periods, and we will select projects which have shorter payback periods. And usually short-term projects will have shorter payback periods because short-term projects are supposed to cover their investment early, whereas long-term projects will take time to cover the initial investment. So all the time we will be accepting the short-term projects. So we'll be losing long-term projects to get the short-term projects. So it will make us short-termist. So we will be very much short-term focused. So these are the two limitations of payback period. We can't remove the second drawback of the payback period. It is its inherent limitation because the name itself suggests that it's the payback period on the basis of which we will select the project. So we can't remove this limitation out of the payback period. But yes, we can consider the time value of money. So the first limitation can be removed, but not the second one. So to consider the time value of money, that is the cost of capital, we need to calculate a discounted payback period. The payback period that we just calculated was a simple payback period. Now we will move to calculate a discounted payback period which will consider the time value of money. Any question before I can move to the calculation? Kindly ask question one by one so that I can answer each one of you. Excuse me. So let's move towards the next slide. Discounted payback period. All we have to do is to get the same cash flows again. It's the same question. Now we are considering a cost of capital of 6%. So all the cash flows are same, the initial investment is the same, the project life is same. And we need to calculate the discounted payback period for this project. And how do we calculate it? There will be an additional calculation for calculating present values. So we've put all the cash flows again at their corresponding years. We have put the discount factors for 6%. We don't need to go back to the table. We all have discussed that yesterday, how we find out the discount factors at different rates. So I've already picked the discount factors, 0.943, 0.890, 0.840. It's all at 6%. So what I've done is I have calculated the present value of these cash flows. So we have deducted the return out of the cash flows. So we've calculated the present values. Now we'll just ignore these cash flows and we will consider these cash flows, the present values of the cash flows. Now we'll again calculate the cumulative cash flow, but this time we will use present values to calculate the cumulative cash flows. So we'll write $25,000 as we wrote in the previous example, $25,000. Of the $25,000, we have received $8,487. So how much we are left with? So we'll deduct 8,487 from 25,000 and the amount will be 16513. So I've deducted $8,487 from $25,000. Then at the end of the second year, suppose that we have received $8,900. So we will be left with 7613 negative. And at the end of the third year, if you can see, we have received more than the amount of investment left. That is 10080. So we'll have a positive cash flow, indicating that we have covered all of our investment. So it's 24267. Now, how will we calculate the payback? We'll calculate it the same way. If you see that it took 2 complete years, plus we are still to cover $7,613 by the end of year 2. So definitely these $7,613 are covered at the end of somewhere in between year 3. So we'll write 7613, the amount that we are going to cover in year 3, divided by the whole present value of cash flows of year 3, 10080. What will be the answer? Can anybody tell me in fractions? It's 2.76 years. Thank you. And the simple payback period was 2.5 years, remember? Yes, we can multiply 0.76 with 12 to get the answer in months. So we'll get 2 years and I guess 9 months, yes. Now, look at these two values. This is not a coincidence that we have got a higher value for this discounted payback period than the simple payback period. This will always happen. The discounted payback period, remember, will always be longer than the simple payback period. And the reason is that in simple payback period, we are just concerned with the recovery of initial investment. Whereas in the discounted payback period, we are interested to cover both our initial investment and cost of finance. Well, Shiraz, you may use abbreviations, but make sure that they are very much clear. The objective of examiner is to know what you have calculated. So you must be very clear with your abbreviations, then you can use abbreviations. Ziyak, we usually don't need to calculate the answer in days. So we will be asked to calculate in years or months. That's it. So there's no need to calculate in days. Nasir, I have already discussed simple payback period for NVT. We have already discussed it. Well, if it's a multiple choice question, it will be given the form of options, and you have to pick from there. So it might be in points or it might be in months. As far as the descriptive type question is concerned, you can write it in both ways. You may write it in years, or you may write it in years and months. Nasir, if we have an annuity project and we take the present values of the cash flows, then automatically we'll get uneven cash flows. So the NVT project will even be converted into non-NVT once we have calculated the present values. So the present values for every cash inflow will be different. So again, you have to use the same technique that what we have used for this question. Okay, I hope everybody has got the payback period. Any question, or should we move forward? Akasha, if we have a negative cash flow at the end of the project even, it means that the project has a negative net present value and it won't ever be able to cover its initial investment. So there's no point of accepting this project. Yes, Sikandar, you're right. I'm trying the same. Okay, let's move towards our next area, and that is the advanced NPV. So just hold your questions. I will start. I will give you time to ask questions. Write down your questions with yourself. And when I ask you to ask the questions, just come up with me, because if you ask in between the discussion, I might miss your questions. So it would be great if you ask when I ask you to ask the questions, so that everybody's question is answered. I hope. Okay. Now what we have to do is to discuss this NPV pro forma. Look at this pro forma. In all our previous examples, I have given you the cash flows for the year. For example, at the end of year one, I've told that we are going to receive $9,000. And we are aware that when we operate any project, every year there will be cash inflows and there will be cash outflows. So before we can calculate the present value of cash flow, we have to net off the positive and negative cash flows first. In all our previous examples, we were given the net cash flows for the year. So all we had to do was to calculate the present values. Now what we have to learn how to calculate these net cash flows for every year before we can discount them. So we have this NPV, net present value pro forma, on your screen. Let us discuss the contents of this NPV pro forma. It's not the complete list of items that will come in the NPV pro forma, but it will give you a good guidance of how we calculate net cash flows. If you look at this, it starts from sales. And all of us know that sales generate cash inflows. So the sales figure will always be positive. So what we have to do is we have to write the sales figure in the relevant years. So in every year, whatever sales we will generate, we'll write it in the respective year column. So we'll write these cash inflows. Okay. Remember, in investment appraisal, we assume that the cash flows will occur at the end of the year, especially the operating cash flows. The operating cash flows, we assume, though the sales will be made throughout the year, but since we can't trace sales of every day, we can't calculate it 365 days. So we assume all the sales will be made at the end of the year, along with the all operating cash flows. So sales will start from year one and will continue till the end of the project. Then we'll take the operating costs. The operating costs will include both variable costs and fixed costs. So variable costs will always be considered relevant in net present value calculation, whereas the fixed costs, they will usually be treated as relevant, but in some cases they might be treated as irrelevant, where the question has expressively mentioned that the fixed costs will not be affected by the project. If the fixed costs are not affected by the project, then those fixed costs will be irrelevant because they will have nothing to do with the project. But in case the question is silent, or the question states that the fixed cost will be incremental fixed cost, then we must consider those cash flows as well. So the costs should be variable cost and fixed cost usually. So we'll subtract variable and fixed cost from the sales. We'll get pre-tax cash flows. Remember, we have to subtract all the operating costs that affect taxation. So we have to subtract it. Then comes the tax. Since tax is a negative cash flow, so we'll write it in brackets. Then we might be considering the initial investment. Not necessarily we incorporate it in NPV pro forma. We can deduct it at the end as well, but we can also mention the capital expenditure at year 0 in the NPV pro forma as well. Then we might have scrap value. We might be selling the machinery or the asset which we are purchasing at point 0 at the end of the project. So we'll write scrap value as positive value. Then we have tax benefits on capital allowances. What are these? We'll discuss it later. So for now, we're just ignoring it. Then we might be requiring working capital. And all of you know that working capital is the amount of capital that we need to run day-to-day operations. So we'll be incorporating the working capital cash flows. And if you see these 3 years show negative working capital and the rest of the two show positive cash flows. And why is it so? We'll discuss it in a while. So once we are done with all the cash flows, the positive ones, the negative ones, and now we will net off all those cash flows to get the net cash flows figures. These are the net cash flows for every year. Now these are the net cash flows for every year. Then we will apply the discount factors. In previous example, these figures were given in the question. And now we have to learn how to calculate these. So we'll put the relevant discount factors, we'll multiply the net cash flows with the discount factors to get the present values, and then we'll get the net present value. So any question? Yashasvi, I will try to put some videos on my YouTube channel. I will share the details, and you can also find the recording of this webinar on Vimeo, but you will be provided with the access to the recorded version of this webinar as well. VC as a variable cost and FC is a fixed cost. Yes, usually they both will be deducted. Zirek, we'll discuss it why it is negative at start and why it is positive at the end. In the next question that we're going to solve, we'll discuss it. Namshad, yes, we will only take the relevant cash flows. It's not only about the fixed cost, it's about the every cash flow. Whether it's variable cost, whether it's fixed cost, whether it's sales or any other cash flow, we'll only take the cash flow that are relevant to this project and will not take the irrelevant cash flows. Taha, sometimes we will be taking tax at year 0 as well, but usually we don't, because at 0 0 is the starting point, and if there is no profit, there will be no tax. Definitely at point 0 we won't be making any profits, so there will be no tax. But sometimes we might be putting tax here as well. So let's see, we'll discuss it. Okay, let's move towards the question. I will read the question for you, and while reading, I will be trying to highlight the figures that we need to keep in our mind before when we'll be solving the question. So stay with me and listen it carefully. SC is evaluating the purchase of a new machine to produce product P, which has a short product life cycle due to rapidly changing technology. The machine is expected to cost $1 million. This is our initial investment. Production and sales of product P are forecast to be as follows. Production and sales in units. Every year these are the sales in units. So it's a 4-year project actually. The selling price of product P in current price terms, for the time being, what is current price term? We'll just ignore. So it will be 20 per unit. While the variable cost of the product will be $12 per unit. Selling price inflation is expected to be 4% per year, and variable cost inflation is expected to be 5% per year. No increase in existing fixed cost is expected. This is what I was talking about. It's very much clear that the project will not result in any additional fixed costs. So we won't be considering fixed cost in this example. And it has also told us the reason why there will be no additional fixed cost. It means that it is a spare capacity, both space and labor terms. So it will not lead to any additional fixed cost. So producing and selling product P will call for an increased investment in working capital. Analysis of historical levels of working capital within SC company indicates that at the start of each year, investment in working capital for product P will need to be 7% of sales revenue for that year. So every year, we will be needing 7% of the sales revenue as our working capital. So we will discuss in detail when we'll be solving the question. SC company pays tax of 30% per year in the year in which the taxable profits occur. Liability to tax is reduced by capital allowances on machinery. That's tax allowable depreciation, which SC can claim on a straight line basis over the 4-year life of the proposed investment. The new machine is expected to have no scrap value at the end of the 4-year period. So there will be no scrap value. SC company uses nominal. So what is nominal? We will discuss when we will be discussing the inflation. The SC company, for the time being, just ignore it. SC company uses after-tax cost of capital of 12% for investment appraisal purpose. No requirement has been mentioned, but we need to calculate the net present values. Excuse me. So we need to calculate net present value. I am unable to do question. Ubaidullah, what's the problem? Can you explain what's the problem? Ubaid, can you tell me what's the problem? Why are you not able to do the question? Okay, let's move towards the question. Okay, let's now first discuss the selling price of the product P will be 20 per unit, and the selling price inflation will be 4% per year. That means that the price will start increasing at 4% per year. But will we start from year 1 or we will start from year 2? That's the question. If you look at this, they say that the price in current terms, current price terms, and the current price term means at point 0. So at point 0, the price is $20. And I have told that we assume that the sales will start by the end of year 1. So we assume that the sales will be at the end of the year 1, whereas the price mentioned is for point 0. So it will take 1 year, and in between the price will increase by 4%. So remember one thing, we incorporate inflation right from the first year. We incorporate price right from the first year. So remember this, we have to incorporate inflation from year 1 onwards, from year 1 and onwards. So let's start calculating the inflated prices. So I've written 1, 2, 3, 20, 20, 20, 20, and then we'll adjust the inflation. Since the inflation is 4%, so we have to increase the price by 4% in year 1. So I'll just write 1.04. So we'll multiply 20 with 1.04. It will inflate the price by 4%. So can anybody calculate this figure for me? Tabassum, yes, it will always be mentioned that it is in current price terms. Even if it's not mentioned, we usually incorporate inflation right from year 1. It's 20.8. Okay, thank you very much. It's 20.8. Okay. For year 2, we will not multiply it with 1.04 because it will again give us 20.8, and it means that there will be no change. So what we will have to do is we'll just multiply it with 1.04 raised to the power 2. So we'll actually multiply it twice with 1.04. So first just square the 1.04 and then multiply it with 20 and tell me the answer. For year 2, kindly tell me for year 2. Yes, we have to round off to 2 decimal places. $21.63 for year 2, right? Okay, tell me for year 3. For year 3. No, it's not mute. I hope everybody's able to hear me. For year 3, it's 22.5 or 0.49? 22.5, that's right. 22.5 because we have to multiply it by 3. What about year 4? 23.4 approximately. Okay, thank you. Now we have got the inflated prices, and now we'll multiply it with the sales volume to get the total sales revenue of every year. So can you people help me calculate the inflated sales, total sales for year 1? One by one, for year 1. Okay, 728,000. Okay. Okay, for the year 2. For year 2. Kindly mention the year with the figures. Kindly mention the year with the figures. So it's 1146390. Okay, for year 3, it's 1687500. And for year 4, it's 842420, right? So these are the inflated sales. Now we'll move towards calculating the variable cost. So let's just calculate the variable cost. Let's calculate the variable cost. Variable cost mentioned in the question is $12, and it will start increasing by, just check, the inflation rate for variable cost is 5%. Remember, it's 5% for variable cost. So the selling price was increasing by 4%, and the variable cost inflation is expected to be 5%. So we'll repeat our calculation, but this time we'll use 5%. So the inflation factor here will be 1.05, 1.05 raised to the power 2, 1.05 raised to the power 3, 1.05 raised to the power 4. So just multiply and calculate these figures for me. Can you tell me the variable cost for year one? For year one, it will be 12.6. Okay, thank you. Thank you, Sana. Everyone else should mention the year as well. For year two, it's 13.3, sorry, 23. Okay. For year three, 13.89. Okay, thank you. For year four, and everyone else should follow the calculation. You should be doing it yourself so that you know how these values have been calculated. $14.58. Okay, now multiply these inflated prices with their respective sales volume to get the cost of sale. What will be the total cost for year one? The total cost for year one. Okay, 441,000. Okay, for the second year, okay, thank you. Now just remember these figures, write it down. We'll be needing these figures when we'll be filling the pro forma for net present value. So we'll be needing these figures there. So anyone having any question, just quickly ask a question, and otherwise we'll move forward. So we are done with the inflated sales. We are done with the inflated variable cost. So if anyone has any question. Okay, now we are going to move forward. Okay, let me switch to the pro forma first. Okay, this is the pro forma. So we'll write the sales figures that we have calculated. Can anybody tell me the sales figures for every year? I don't need to. Anyone? Sales figures for every year? Okay, let me switch the slide. The year one sales figure 7,28,000. So we'll write it here, $7,28,000. Okay, this is for year one. For year two, it's 1146390. 1146390. For year three, it's 1687500. 1687500. And for year four, It's 842400. 842400. So these are the sales figures. Now we'll put the variable cost figures. Variable cost for year one, $4,41,000. And since it will be cash outflow, so we'll straight away put the bracket sign. Then we have 701,190. 701. Then we have 104,1750. Year four, it's 524,880. Okay, since we don't have fixed costs in this project, so we'll just net off these figures to get pre-tax cash flows, because there are no other cash flows that will affect the taxation at the moment. So we'll just subtract this variable cost from the sales. And can anyone help me in doing it? Or should I take my own calculator? 287,000. 1146390 minus 701,190. So it's 445,200. Then 168,7500 minus 104,1750. That's 645,750. 842,400 minus 524,880 gets 317,520. All these figures are correct or not? Are you done? Are you people done with these figures? Okay, these are the pre-tax cash flows, and we will apply the tax at the rate of 30% on these cash flows. So for the first year, we will take 30% of 2,87,000. So 287,000 in 0.3. So it's 86,100. Now the tax for 2,87,000, that is 30%, is 86,100. Now, in which column should we write? That's the question. Sometimes the question will say the tax is paid in the year to which it relates. And sometimes the question will state that the tax is paid 1 year after the year to which the profits relate. So in this case, if we read the question again, for the tax part only, it says that SC company pays tax of 30% per year in the year in which the taxable profit occurs. So in this case, we will write the tax figure in the same column for which the tax has been calculated in the same year. But in case the question states that the tax is paid in arrears, then we will always write it in the next column. So here we don't need to write it in the next column, we'll write it in the same column. So we'll write 86,100 in the same column, otherwise we would have written it here. 86,100. Now 445,200 into 0.3. It's 133,560. Then 30% of 645,750 multiply by 0.3. It's 193,725. Then for the last year, 317,520 into 0.3. It's 95256. Okay, we are done with the tax part. Now, if you see, there is tax benefit on capital allowance and balancing allowance. Before I start this, I would like to answer your questions which you have up till now, because I don't want to get into this calculation before I have answered all the questions, because it's a technical one. The tax benefit on capital allowance and balancing allowance will be a technical one. So if you have any questions up till now, do ask me. So any question? Does anyone have any question? Should I start the tax benefit part? Okay, let me start the tax benefit part. Okay, what this tax benefit is? Since we have purchased the asset, we will have two types of depreciation. One is the accounting depreciation that we record in our books, and the other is the depreciation that will be allowed by the tax authorities when they will be calculating our tax. Remember one thing, whether it's the accounting depreciation or it's the tax depreciation, both tax depreciation and accounting depreciation are non-cash expenses, and we never take non-cash expenses into consideration for calculating present values or net present value. So we'll totally ignore the accounting depreciation, because the accounting depreciation does not affect any cash flow. So we'll just ignore it. Now let's come to the tax depreciation, which we call capital allowance. The tax depreciation itself is a non-cash expense, but it does affect a cash flow that is called tax. If you look at the NPV pro forma, which we have prepared so far, we haven't deducted any tax depreciation, and rightly so, because it's a non-cash item, so we should not deduct it from our cash flows. Since we haven't deducted it from our cash flows, the tax currently shown on our NPV pro forma will not be the tax that we will be actually paying to our tax authorities, because tax authorities will deduct the tax depreciation before they calculate our tax liability. So these tax outflows at the moment are overstated, because these are not the amount that we are expecting to pay to our tax authorities. What the tax authorities will do, they will deduct the capital allowance from 2,87,000 of the first year. They will first deduct the tax depreciation from this figure, and they will apply 30% to the resulting figure, which will definitely be less than $86,100. But since it was a non-cash expense, that's why we haven't deducted it from our pro forma. But we must know that the tax appearing in the pro forma financial statement is higher than the actual tax we will be paying. So the actual cash outflow of the tax will be less than the cash outflow shown on the NPV pro forma. So we need to adjust this. We have to add back the tax benefit to adjust this tax figure to bring it to the right cash flow. Now, how we do it? Let's take it year one, and let's go to the question and see what was the cost of the asset. The cost of asset was $1 million. So we will write 1 million here. 1 million here. Now, again, we'll go to the question, and in the question, they said that liability to tax is reduced by the capital allowance on machinery, which SC company can claim on straight line basis over 4 years. Straight line, you all are aware of what straight line is. We will receive capital allowances equally every year. So the cost of the asset will be divided by the life of the asset. Life of asset is 4 years and the cost is 1 million. So we'll divide 1 million by 4. We'll get 2,50,000. So of the 1 million, every year the tax authorities will allow us 2,50,000 of tax depreciation. So they will deduct 2,50,000 from our profits to calculate the tax, which is actually 25% at the moment. Since it's a straight line method, every year the capital allowance will be same. %, 25%, but in the subsequent years, again, we won't take the WDV, because in a straight line basis, the rate applies to the cost every year. So we'll take the cost figure for every year and we'll take 25% of it. Okay, so they will allow 2,50,000 to deduct from our profit to get to the profit tax figure. The tax rate is 30%. So it means that we will not be expecting to pay tax on 2,50,000. So it will save our tax, which is called tax benefit. So we'll take 30% of the capital allowance as our tax benefit. So 30% of 250,000 will be 75,000. So since every year it is same, so we'll get the same tax benefit every year, that is $75,000. Now, this column is also very important. This tells you in which year we will show this tax benefit. Since we have to pay tax in the same year in which the profits are occurring, therefore it will start from year 1, 2, 3, and 4. Had it been in arrears, had the tax been paid in arrears, this would have been started from year 2, 3, 4, and 5. So it's not the case in this question. So these are the tax benefits. We'll have to add back these tax benefits in the NPV pro forma. So we'll write these figures. 75,000. We'll add back 75,000, 75,000 in every year. Now, anyone having any question with this part? Any question? Zirek, we'll explain the reducing balance as well. We'll solve the same question with the reducing balance as well. Sheila, yes, so I will show you, we'll solve the same question with the scrap value as well. So I will show you that. Sidra, the year of payment represents, it actually tells you in which year of the pro forma financial statement we have to show this figure. Actually, it's not something that the tax authorities will pay us. It's the relief that they will give us when we'll be paying the tax. So it will be shown in the same year in which we have to pay the tax. Since we are starting to pay our tax from year 1, so the first capital allowance will be shown in year 1. Muhammad Qasim, yes, we will completely ignore accounting depreciation since it is a non-cash item and has no tax impact as well. So we'll completely ignore it. We will consider tax depreciation and only consider it for tax purpose, and we will not show it in our NPV pro forma. We'll just show the tax impact of the tax depreciation. Waqas, yes, if the scrap value is nil or if they say there's no scrap value, both mean same. Sidra, I hope I have answered your question. Since I haven't discussed inflation yet, we'll discuss it later, but no. The answer to your question is no. Uh, Tax rate has nothing to do with inflation. It will be decided by the tax authorities and it will be given in the question, so we don't need to adjust tax rate with the inflation. Excuse me. Sakhi Hasnain, please tell about the incorporation inflation in year one or year two. What do you mean by this? I didn't get your question. I didn't get your question. Uh, Aisha, I haven't seen a single incidence of this that the question will be silent about the percentage of the reducing balance. It will always be mentioned in the question. We can't assume it from our own self that it will be 25%. Uh, Whenever there's a reducing balance method, the percentage of capital allowance will always be mentioned in the question. Uh, Rizwan, we will be discussing inflation in detail, so don't worry, it will answer your question. Sakhi, the inflation is usually adjusted from the very first year. Taha, balancing allowance will be discussed in the same question. Let me finish this question and then we'll solve the same question again with reducing balance and with scrap value, and I'll discuss it. Namshad, yes, to a great extent the same performer, but it might add a fixed cost. You might have to add fixed cost and some other cash flows as well. It depends on the question, but the basic structure of the performer will be the same. Luke, I will solve the same question with reducing balance, and you will get your answer. Yes, Aisha, it was not mentioned uh, because it was a straight line method. It wasn't a reducing balance method. It was a straight line method. That's why they didn't mention. And we know in a straight line method, the asset is depreciated equally during its useful life. So we have divided it with the useful life to get this figure. So since the useful life was 4 years, and if you depreciate something on a straight line basis over 4 years, it means you are going to depreciate it 25% every year. Yesh, Yashasvi, I didn't get your question. Can you just explain your question? Safir, yes, we add it when it is incremental. Taha, I will solve the question with scrap value and you'll come to know whether we add balancing allowance or we subtract the tax benefit of balancing allowance. Safir, yes, if it is incremental, we subtract the incremental fixed cost from our sales. Talha, usually we adjust inflation for every year, and there will always be power to it if we start from 0 point. But if we are inflating the year one figure, we don't need to put in any power because it will, the power only comes when we have to inflate something for 2 or 3 years. Nasir, we will be discussing the scrap value in a while. Okay, Bilal, I'm just repeating the tax benefit. Just listen, everybody. Everyone should listen carefully. The tax benefits actually, uh, we are calculating net present value, and we do not take non-cash expenses. So that's why we haven't included a capital allowance in our calculation here. Since we haven't calculated our capital allowance, we haven't incorporated the capital allowance here, so the tax figure will be overstated because when the tax authorities will be calculating our tax, they will deduct the capital allowance. We haven't deducted capital allowance and straight away calculated the tax figures. So these tax figures are slightly overstated because of not incorporating the capital allowance. So to adjust this capital allowance to the right figure, we have to add back the impact of tax, the impact of the capital allowance on the tax. So we have added 75,000. Well, Namshad, I think you people should avoid the questions of if, because there will be unlimited scenarios and unlimited questions, unlimited answers, and we have very limited time. Just stick to this, the calculation that we have so far done. If there is any problem with the calculation that I have done so far, do ask me the questions. And for all other questions that are coming in your mind, I will share my contact details with you. We can have a discussion after the webinar. So I will always be there to answer your questions. So at the moment, just stick to the topic. Just ask me the questions regarding the calculations that we have done so far. Okay, let's move towards the next calculation, that is working capital. So working capital is the amount of capital that we'll be needing to run our day-to-day business. So in the question, it states that we need 7% of the sales revenue as our working capital for the start at the start of every year. So for year one, the sales revenue is 7,28,000, and remember, it has the impact of inflation in it. 7,28,000. So according to the question, the year one working capital requirement will be 7%. Working capital will be 7% of the sales revenue. So if you people can calculate 7% of the sales revenue for me, 7,28,000. What's the 7% of 7,28,000? 728,000.07. Can anyone calculate it for me? Is it 50960? Okay. Now, remember this thing. This is the requirement for year one, but we will not write it in the year one column because year one column represents end of the year. And what we need during the year, we cannot incorporate it at the end of year one. So whatever we will be needing during the year one, we need to incorporate it at the start of year one, and at start of the year one is actually 0.0. So the working capital is usually incorporated at 0.0 so that we can carry our operations during year one. So I will write 50960 in year zero. Though this figure relates to year one, but I will not write it in year one column because it would mean that we are incorporating the working capital at the end of year one, whereas we need it during the year. So we'll write it at 0.0, and since it's investment, therefore we will write it as a negative figure. So for year one operations, we need to induct 50960 at the start of year one, that is 0.0. Okay. Now, can anybody calculate the year two figure for me? 1146390 into 0.07. Okay, Rizwan, thank you. Nasir, thank you. 80247. Now, listen carefully. Everyone should listen carefully. The story for year two will be a bit different. We need a total of 80247 to run the operations of year two. But we already know we have injected 50960 at the start of year one. So if we incorporate 80247 at the end of year one, it will exceed what we need for year two because we already have injected 50960. So we will not put in an additional 80247. This is our total requirement for year two. It's not the additional requirement for year two. So the total requirement for year two is 80,247, of which we have already inducted 50960. So we will only induct the additional amount, that is 80247 minus 50960. So we'll only incorporate the additional amount that we need for year two operations. So can anyone calculate the difference for me? Thank you, Ravi. 29287. Excellent. 29287. So this is the additional amount that we will be inducting at the end of the year one to run our operations for year two. Okay. Can anybody calculate the total working capital requirement for year three? Can anyone calculate the total requirement for year three? It's 1687500 into 0.07. Just multiply, just take 7% of the year three sales figure. Okay, thank you. What's the figure for year three? Is it 118125? Is it correct? Okay. Now we need 118125 for year three operations, and we have already injected 80247 by the end of year two. Sorry, by the end of year one. So the additional amount that we need to induct at the end of year two for year three operations will be 118125 minus 80247. So it will again be an additional amount. So what's the additional amount? What will be the difference? 118125 minus 80247. Marianne, we haven't spent 50960. It's a capital actually, and capital isn't spent. It is kept in the business. It will rotate. By the end of year one, we would have sold our inventory. We would have covered all our expenses through sales. So the working capital is never spent unless and until you make a loss. So 50960 of year invested in year one will stay in the business, and for year two it will be again used in the for year two operations. So it's not an expenditure actually, it's a capital, and capital is rotated in the business. So that's why So the additional is 3A7878. So we'll write it 37878. Okay, thank you. Okay, can anybody calculate the requirement for year 4? 842,400 into 0.07. Okay, 58968 is for year 4. Okay, just remove. Okay, 58968. Now it's very interesting. In the earlier years, the requirement was higher than the amount injected. But in this, for the year 4, we only need 58968. And if you see, we have already injected this much into the business, but we actually need 58968 for the business. So we will not keep the additional amount with us. We'll just eject this amount out of the investment. We'll eject this amount out of the project. So what's the difference? We have invested capital of 118,125 and we need 58968 only. So the additional amount will be taken out of the investment. So it will be cash inflow now. So can anybody calculate the difference for me? Okay, 59157. Okay, thank you. 59157. So now this figure will be a positive one because we need less than we have already invested in the business. So we have ejected 59157 and the end of year 3. By the end of year 4, we will not be needing any working capital subsequently. So whatever is left in the business should again be ejected from the project. So what are we left with actually? So what working capital are we left with? Okay, Taha, I will explain it for you. Don't worry. We have invested. Just give me a minute. I'm having problems in getting your messages. Just wait a minute. Okay, okay. Now for the last year, what we have to do is, yes, Sheila, am I audible to you, right? Okay. For the last year, what we have to do is remember working capital is a bit different from the expenditures. It's not expense, it's a capital, and we all know capital stays in the business. So for the last year, we have to recover the whole of the working capital we invested. So what we have invested is the sum of these three. So the sum of these three was invested in the business, and this was recovered by the end of year three. So for year four, whatever remaining is left should be shown in year four. So can anybody add these three figures for me? Can anyone add these three figures for me so that we know that what we have invested till the end of year two in working capital? Okay, thank you, Kulan. It's 118,125. So these three figures were invested by the end of year two, of which in year three we recovered 59157. So what we are left with 59157. So okay, it's 58968. So this is the amount that we are left with. And by the end of year four, we will recover this investment because the project will finish and we will not be having any requirement for working capital thereafter. So 58968 will be recovered after the end of year four. Now remember, one key point is that the sum of these all five figures should be equal to 0. These three negative figures and these two positive figures should cancel out each other. Because whatever capital was invested should be ejected by the end of the project. Well, in that case, we don't need to show it actually because it's simply a 7% of the sales revenue. So even if you don't show it, it will be okay. But where there's a complicated calculation involved where we have to adjust the inflation separately, then we might need a separate calculation for working capital. Zirek, it's positive in year three because the required working capital is less than the amount already invested in the business. So we have to recover the working capital rather than investing it further. Bilal, what's the point of keeping a capital when the project is not there? Definitely, since the project is over, so you don't need to keep this capital invested in the project. You will use it for some other project, so you should not be showing it as investment in this project. Did you get it, Bilal? Bilal, did you get it? We eject the capital at the end of the project due to a very obvious reason that the project is no more there. So there is no point of keeping the capital in the project since the project is over. So whatever capital you've invested in this project should be ejected so that it can be invested in some other project. And I'm sorry that I don't look at the cameras because I have to look at your questions. Okay, let's move forward. We're done with the capital. Bilal, working capital is injected to help us run our routine business. Actually, it's very much obvious that when you're starting a project, you need a working capital, so you have to invest, so you have to show a negative cash flow. But once the project is ended, you have to show a positive cash inflow regarding the working capital because the working capital now will be ejected from the project. So when it was injected, we had a negative cash flow. By the end of the project, since the project is over, so we have to eject the working capital and we have to show a negative cash flow. Now, once the project is over and you take out the capital wherever you need, it has nothing to do with this project. So wherever you will be needing this capital, you will take it there. Okay, let's move forward. What else we have in the question? Let's see. We are done with the working capital. We don't have any scrap value, so we'll write it nil. We'll have no scrap value. Remember the scrap value, if it's there, it will be shown at the end of the project because we will sell the asset at the end of the project. So it will be shown at the end of the project and it will be shown as a positive cash flow because when you will sell the asset, you will get the cash flow. Okay, we don't have any other thing in the question, so we'll net off all these figures to get the net cash flows. So it will be 50960. Okay, just calculate the net figure for year one. Initial investment will be incorporated at the end, Sheila. When we'll be calculating net present value, we'll just incorporate there. So don't worry, it will come. For year one, it's 246613. For year two, it's 348762. Okay, thank you. And what about year three? Yes, Shiraz, calculate it for me for year three. Okay, 586182. And what about year four? 356232. Okay, just cross-check everyone, and I hope the answers are correct. Okay, what was our cost of capital? Let's go back to the question first and see what was our cost of capital, right? So let's check cost of capital so that we know what discount factors we need to see. The cost of capital was 12%. Now, I would like all of you to tell me the discount factors for 12%. For year zero, it's always 1. So tell me from year 1 and onwards. For year 1, Shiraz, tell me for year 1. 0.893. Okay. For year 2, 0.797. For year 3, 0.712. For year 4, 0.636. Thank you very much. And now multiply the figures, the net cash flow figures with the discount factors. For year 2, 277,963. Okay. For year 3, 417,362. And for year 4, it's 226,554. And okay, now sum all these three figures, net off these three figures, add these four and subtract 50960 and tell me what's the value. Bilal, it should always be post-tax if you have incorporated tax figures in the calculation. So it should always be post-tax, after tax. Can anybody tell me the total present value of cash inflows? Total present value of inflows 1091154. I hope you have subtracted 50960 from this figure. Okay, what's the initial investment? 1 million. Okay, so what's the net present value? 91154. This is the net present value. So it's positive. If the question asks us to recommend what should be done, the answer will be to go for the project since it has a positive net present value of 91154. So I hope everyone has understood the question solution. Hi, Rishab. Well, this is the exam level question, and yes, the level of difficulty might change. So it's actually the past exam question what we have solved. Yes, Taha, the break has started. So it's a break of for 10 minutes. And I won't go for break. I would like to take your questions, and anybody else can go for a break of 10 minutes. Yes, Rishab, definitely the project, the objective of calculating net present value is to take a decision. So definitely it will be calculated before the project decision is taken. Yes, Ubaidullah, you may ask. So in this, for asset replacement, I will recommend my video to you later on. I will share the link for asset replacement. You may go through the video, and if you have any questions, you can ask me later on. Okay, so they say ignore working capital recovery in this example. Well, if they say ignore the working capital recovery, then we will not show any positive figure at the end of the project. That's it. Ghulam Tabassum, I will share the details by the end of the webinar with you regarding my YouTube channel and my Facebook page. Rishab, if the difference is due to rounding off, you will not lose any marks. Make sure that you don't make any conceptual mistake. So you may round off the figures to two decimal place in case of decimals, and you may round off it to nearest thousand as well in some cases. Ubad, we have used capital allowances from year one because the first tax payment was in year one. So from wherever the tax payment starts, usually we show capital allowance in the same year. Azim, yes, it was a past paper question, past exam question. Muhammad Qasim, can you show all the working slides one by one? Yes, I will show it for you. These are the working slides. So can you please give us brief time slot on what time should be given to each topic when studying for exam? Can you please give us brief time slot on what time should be given to each topic? Zambilal, I didn't get your question. Can you just explain it further? Well, capital allowance was not taken in year zero because the capital allowance is not something that we will get from our tax authorities. It's actually the reduction of the tax due to capital allowance. So you will get this relief when you are going to pay your first tax. So since we were paying our first tax in year one, in the same year we will get the tax relief. So that's why we have shown it in year one. Bilal, if the question says that ignore working capital recovery, then by the end of year four, we will not show any positive cash inflow regarding the working capital. We'll keep it in the business. So we'll only show the outflows. Yes, I will, by the end of the webinar, I will recommend few questions to all of you, which you'll solve at home. Uh, yes, Sikandar, I will try my level best to give you an assignment that you can do it easily at home. Uzair, usually when it's an NPV question, one of the theory parts will be just to recommend a course of action what the company should do, and it will be a one-line explanation, that is whether to go for the project or not, And for the other parts, it might ask for for the comparison of NPV with IRR. We'll discuss it. The when to use NPV and when to use IRR. So it depends on the question that what has been asked. So in year three of this example, do we have to show positive working capital if in case examiner says to ignore working capital recovery? Year three of this example, Muhammad Ali, yes, even if it says that ignore the recovery of the working capital, at the end of year three will show positive inflow, but by the end of year four will not show any positive cash inflow. So this thing has nothing to do with the other years. This is just for the last year, usually. Ghulam Tabassum, yes, it's always recommended that you write figures in thousands or millions. It's always recommended to apply degree of precision in your exams. So you should write it in this way. Luke, what theory questions may come up? Well, theory questions regarding investment appraisal might be the comparison of NPV and IRR. It might ask about incorporating risk in the investment appraisal. We will discuss by the end of our investment appraisal topic. Usually, the investment appraisal questions are not followed by theoretical portions. There's very little about investment appraisal where you have to explain theory. Most of the investment appraisal questions will be calculating net present value, IRR, or payback. Do we lose marks if the same is not in line with format? Well, there is no specific formats, so you won't lose marks for not reporting NPV or calculating NPV in a particular format. So whatever format you want to use, you can use it as long as it is clear and it's easy for examiner to check. Sidra, don't you have the slides with you? Muhammad Ali, yes, we have to show calculations wherever the calculations are more complex. Aisha, what type of tips are you talking about? Muhammad Ali, no, we are not doing sources of finance today. We will be starting cost of capital today. No issues, Farooq. Well, Kulan, we only show working in the performer when it's simple. We can't show complex calculation in the performer. So if it's a one-liner calculation, we might show it there. But if it's a more complex calculation, we don't show it. Okay, let's start. Let us start our next question. Lease or buy? Okay, let's now hold your horses and we'll just we'll start our next topic, that is lease or buy. Well, it's another investment decision topic, lease or buy. Remember, we take two types of decisions. One decision will be whether to invest in a project or not. That is called investing decision, which we uh, just discussed in the previous question. And the other question is to decide about the financing of the project. How should we finance the project? So we are done with the investing decision. Now we are going to take the financing decision. We have to learn how to take the financing decision. So lease or buy is usually a financing decision, and in this type of questions you will be asked to decide which source of finance should we decide. Usually we compare two options. One option might be to lease the asset, to acquire the asset through lease, and the other will be to purchase the asset by paying the cash outright. So we have to decide between these two options. That's why we call it lease or buy option. Remember, since it's a financing decision, and we will only consider financing cash flows. What do we mean by financing cash flows? We consider only those cash flows that affect our that are affected by the decision of financing. Say, for example, if we are going to purchase or lease a machinery which will increase our production and will increase our sales. Now, if we get the machinery, it will produce additional units irrespective whether it has been leased or it has been purchased. In both cases, it will give us more production and more sales. So in that case, sales and operating cash flow, that like variable cost and fixed cost, will not be affected by the leasing or buy decision. So in case we are going to decide about lease or buy, remember we do not consider sales revenue. We ignore sales revenue. We ignore operating cash flows, which will be incurred whether we go for leasing or buy. So we will only consider cash flows that will be affected by our decision of lease or buy. Let us discuss some cash flows which will be affected by this decision. Sales revenue. Okay. Just answer me in yes or no. If I decide to buy an asset or I decide to lease an asset, will it affect my sales revenue? Yes or no? No. Okay. So sales revenue will be irrelevant because leasing or buying will not affect the sales revenue, because even if we lease the asset, it will produce the same number of units. If you buy the asset, it will produce the same number of units and will be able to sell in the same way. So it's irrelevant. Will it affect our variable cost? Will it affect our variable cost? Yes or no? No effect, because if we lease the asset or we buy the asset, we have to use the same amount of material, we have to pay the same amount of to our labor, so it will not be affected. Okay, operating fixed costs. Operating fixed costs. No, again, it will not be affected. Rishab, what do you mean by yes? How will it affect our operating fixed costs? Interest payment is never an operating cost. It's a finance cost. So I'm talking about the operating cost. Well, Khulan, just take an example. If you are going to buy a car or you lease a car, and if you want to go to your office daily, it will travel the same number of kilometers whether you buy or whether you lease it. In the same way, if a company buys a machinery or it leases a machinery, its output capacity will not be affected by leasing or buying. It will give the same output every day irrespective whether you have bought it or you have leased it. So it will give you the same output, and you will be able to sell the same amount of same number of units. So again, it will be irrelevant. So now what will be relevant? Let's see. Will it affect your scrap value? Yes, it will, because if you lease the asset, you don't own it. Since you don't own it, you won't get any scrap value for it. But if you buy the asset, since you own it, by the end of the period, you may sell it and you get the scrap value. So the lease or buy decision will always affect the scrap value. So whenever we will be taking the decision of lease or buy, we'll take scrap value into consideration. Okay, will it affect the initial investment? Mohammed Ali, operating lease and finance lease are just the external reporting terms in F9, whether it's operating lease or finance lease, they are treated in the same way. So yes, initial investment will also be affected, because if you buy the asset outright, you will have to pay a whole amount at point zero. Whereas when you lease, you will be leasing the asset, you don't need to pay the whole amount at point zero. So the initial investment also be affected. So it will always be relevant. Okay, tax benefits on capital allowance. Will this be affected? Yes, because if you lease the asset, it means you don't own it. Since you don't own the asset, tax authorities will never allow you capital allowances. So they will never allow you capital allowances, so there will be no tax benefits on capital allowance in case of leasing. But in case you purchase the asset, you will get the tax benefit on capital allowances. Therefore, this will also be relevant. Okay, lease rentals. Yes, this will also be affected, because in case of purchase, you don't need to pay any lease rentals. In case of lease, you have to pay the lease rentals, so it will also be affected. Tax benefits on lease rentals. Yes, the tax benefit on lease rentals will also be relevant, because you will only get the tax benefit on lease rentals in case of leasing and not buying. Sometimes maintenance cost will also be relevant. In case of buying, the maintenance cost will always be borne by the company itself. But in case of leasing, the lease agreement might expressively say that the company needs not to maintain the asset. So in that case, maintenance costs might not be borne by the company. So in case maintenance costs are affected by the decision, they will be relevant. In case the maintenance cost is not affected by the decision, it will be irrelevant. So it's a subjective matter. It will depend on the question requirement. So not every time it will be relevant, but it might be relevant at times. Yes, it's Harun, it's our fixed cost, but I have kept it separately from the fixed cost, because this type of cost, maintenance cost, will sometimes be considered relevant, depending upon whether the maintenance cost will be affected by the decision or not. So sometimes it will be considered irrelevant, or sometimes it will be considered relevant. So it totally depends on the question. Waqas, whenever we pay tax lease rentals, the tax authorities consider it as an operating cost, and they allow this as a tax allowable expenditure. So they give us relief on the lease rentals. So it will be treated as our cash outflow in case of lease rental, and the tax benefit will be shown as cash inflow. we will be discussing it in the question. Now let's go to the question. This is a past exam question. Kulan, maintenance cost will usually be considered relevant, but not necessarily in every case. Depends on the question requirement. The basic principle behind the concept of relevance is that if we have to pay maintenance cost in one option and we don't have to pay it in another option, then it is relevant. But if we have to pay maintenance cost irrespective of the choice we make, then it's irrelevant. Okay, let's read this question. Lease or buy a SOP company. It's a past exam question, a typical lease or buy question. A SOP company is considering an investment in new technology that will reduce operating costs through increasing energy efficiency and decreasing pollution. The new technology will cost $1 million and have a 4-year life. At the end of the project, at the end of which it will have a scrap value of $1 lakh. A license fee of $104,000 is payable at the end of the first year. At the end of the first year, this license fee will increase by 4% per year in each subsequent year. So in the first year it will be 104,000, but in the next year it will increase by 4%, and thereafter it will start increasing by 4% every year. The new technology is expected to reduce operating costs by $5.8 per unit. Now, sometimes you make investment to generate additional revenue, and sometimes you make investment to reduce your costs. So in this question, the benefit of the investment is the saving in your operating cost rather than generating additional revenue. So this is actually the benefit, the inflow of the investment, and it is in current price terms. Okay. This reduction in operating cost is before taking account of expected inflation of 5% per year. Forecast production volumes over the life of the new technology are expected to be as follows. So these are the production volumes, and if you multiply 5.8 with 60,000, it will give us the total saving that we will make because of this new technology introduction. Okay, if a SOP company bought the new technology, it would finance the purchase through a 4-year loan paying interest at an annual before tax rate of 8.6% per year. Alternatively, a SOP company could lease the new technology. The company would pay 4 annual lease rentals of $380,000 per year, payable in advance. It means it starts from zero. The annual lease rentals include the cost of license fee. So these $380,000 include the license fee as well. If a SOP company buys the new technology, it can claim capital allowances on investment on a 25% reducing balance basis. The company pays taxation 1 year in arrears at an annual rate of 30%. A SOP company has an after-tax weighted average cost of capital of 11%. Now again, the requirement is missing, but the requirement is to decide whether the company should go for lease or it should go for buy option. So let's evaluate these two options one by one, and let's see which is more beneficial. So let's first calculate the NPV of the technology, assuming that we are going to buy this project. Now, whether we buy this asset or lease this asset, remember the savings that it will give to the company will not be affected. So this part will be irrelevant in deciding whether the company should go for leasing or buying the asset. It will still make the company save $5.8 per unit. So this is totally irrelevant in this case. So we will not consider the saving, because once the company has this technology, it will save 5.8 irrespective whether it is bought or it is leased. So it's irrelevant for us. So let's now calculate the NPV of buying option. First of all, let's take the tax benefit. Since the tax benefit on capital allowance will only be available if the company buys it, so we are considering it because we are considering the buying option. What's the cost of machinery? How much it has to pay for that? It's 1 million. So we'll start with 1 million. So it's 1 million for year one, start of year one, 1 million. Aisha, it's irrelevant. Aisha, it's irrelevant because once the company has this technology, it will save 5.8 in its operating cost, whether it has obtained this machinery through leasing or it has bought the machine. So in both cases, it will save. So the option of leasing or buying will not affect our saving in operating cost. Therefore, we will not consider it as relevant. Even if you want to consider this 5.8, you have to consider it in both cases. If you have to consider 5.8 saving in the buying option, then you have to consider it in the leasing option as well. So in both cases, it will be considered. So if you want to consider it in both cases or ignore it in both cases. It will not affect the decision. That's why I'm not taking it. Okay, the cost of asset is 1 million. How much capital allowance we should be allowed? Let's see the question. Capital allowance will be allowed at 25% reducing balance. So 25%. Yes, Sahi, if we have same cost in both options, then it is irrelevant. Either consider it for both calculations or ignore it for both. So it will not affect the decision. So cost of asset is 1 million. We'll be allowed 25% tax depreciation, which will be equal to 2,50,000. The tax rate will be 30%. The tax benefit will be 75,000. Now let's go back to the question. And if you see, the tax rate was 30% and it was paid in arrears, 1 year in arrears. So look at this. This capital allowance belongs to year one. But since the tax will be paid in 1 year arrears, therefore this tax benefit will be shown in year two. In the previous example, the tax was paid in the same year. Therefore, it was year one. Now in this case, since the tax will be paid in arrears, so it will belong to year one but will be shown in year two because of arrears. In the second year, since it's a reducing balance basis, therefore we'll have to calculate the written down value. So 1 million was the cost of asset, and by the end of year one, we were allowed 250,000 of the allowance. So the WDV of the investment will be 7,50,000. So we'll again take 25% of 750,000. Can anybody calculate this for me? What will be the 75%, 25% of 750,000? Yes, Muhammad Ali, we can use 187,500. Okay. And was 30% of 187,500? 30% of 1,87,500. 56250. Since it belongs to year 2 and because of arrears, we will write it year 3 here. Okay, for year 3, can anybody tell me the WDV of year 3? 750,000 minus 187,500, it's 562,500. Okay. Then take 25% of this. 140,625. Thank you, Sikandar. Okay, 30% will be 42188. Okay, thank you. And it will be shown in year 4. Okay. Now just wait. Just wait. Now we are in the last year of the life of the technology. It's a 4-year technology and we are now at the last year. So just hold. Just look at this. We spent 1 million. Of the 1 million in year 1, we are allowed an expenditure of 2,50,000. What were we left with? We were left with 7,50,000 of unclaimed cost of the asset. By the end of year 2, they allowed us a further of 187,500. And we were left with $5,62,500 of unclaimed cost of asset. Now we are, by the end of the 3rd year, we were allowed a further of $140,625 of capital allowance. And we are left with 421,875 of unclaimed cost of asset. Since this is the last year and we don't have any further years to claim the capital allowance, so we have to claim the rest of the unclaimed cost of asset in the 4th year. But since we know the asset will be sold, the asset will be sold for $1 lakh. So it means we will cover $1 lakh of this unclaimed cost of asset by selling the asset. So we will be left with $3,21,875 of unclaimed cost of asset. So the tax authorities will not allow us to claim this as our cost because we will be able to cover 1 lakh of this cost in the last year by selling the machine. So the tax authorities will only allow us the difference of the WDV and the scrap value as our allowance, and this allowance will now be called as balancing allowance. So this will be the amount on which we will be given the tax benefit. So 321,875, we'll write it as allowance here. We'll apply 30% to it. Can anybody calculate this figure for me? So remember, in the last year, we will always deduct the scrap value from our WDV before we can calculate any allowance. So the tax benefit for the last year will be 96563, and it will be claimed in year 5 because it will belong to year 4 and will be paid in year 5. Yes, Mohammed. The 4281 is the WDV of year 3, end of year 3, 421875. By the end of year 4, we will be able to cover 1 lakh by selling the asset. So the tax authorities will not allow 421875 as our capital allowance. They will have to reduce this capital allowance by the scrap value, since we will cover some part of our cost by selling the machine. So of the $421,875, we will cover 1 lakh and we'll be left with unclaimed cost of asset of $321,875. This will be the amount that will be allowed as capital balancing allowance. This will be the tax expenditure. And on this figure, we'll get the 30% tax benefit. Okay, now let's put the figures in the pro forma. Initial investment and scrap value. Initial investment is 1 million, so we'll put it 1 million here. And scrap value will be received at the end of year 4, that is $1 lakh. The initial investment will be in brackets because it's a cash outflow. Scrap value will be inflow. License fee will be 1,04,000 according to the question at the end of year 1, and thereafter it will start increasing by 4%. So can you help me in calculating the scrap value by the end of year 2? What will be the scrap value after the end of year 2 after incorporating the 4% increase? 104,000 into 11. It's 108,160. Okay, increase it by a further 4%. 112,486. Okay, thank you. For year 4, sorry. 116,986. Okay, thank you. So these will be the payments that we'll be making against the license fee. Since license fee will be an operating expense, the tax authorities will allow us to deduct this license fee from our taxable profit, and this will have an impact of reducing our tax. So we'll have to show the tax benefit of this license fee as well. Taha, yes, you might say it's inflating, and it is increasing actually by 4%. Maybe we have an agreement with the license authorities, and they might have in the agreement that the license fee will be increasing by 4%. So this license fee will be claimed as a tax expense and will reduce our tax and we'll get the tax benefit. So we'll take 30% of 1,04,000. So can anybody calculate the 30% of 1,04,000? 31,200. The license fee relates to year 1, but since we pay tax in arrears, we'll show 30% of 1,04,000 in year 2, and it will be 31,200. Okay, thank you. Since it's a tax benefit, therefore it will be shown as a positive figure. Then the license fee for year 2 will be 108,160, and 30% of it will be shown in year 3. It's 32448. Okay. For year 4, 35095, and for the last year, 116986 for the last year. What should be the value in last year? Okay. 33746 and 35097. Okay. So here are the tax benefits of the license. Okay, what else we have? The tax benefits on capital and balancing allowance, we've calculated it already. Tax benefit for year 2 to be shown in year 2 will be 75,000. Year 2, 75,000 positive since it's a tax benefit. Then we have 56250. $42188, and for the last year it will be 96563. Okay, now we don't have any other cash flow, so we'll net off all these figures. 1 million for year 1, 104,000 for year 2. Okay, can anybody net off these figures for me? How we know we can claim tax benefit on license fee, and that too at 30%. Sikandar, license fee is an operating cash flow, is an operating expense, and we expect the tax authorities to allow this expenditure before calculating our tax. So it's very much obvious any operating expense will be allowed as a business expense for taxation purpose. And since the tax rate is 30%, definitely we will take tax benefit at 30%. Manish, you're right. License fee will be paid in both cases, but what license fee will we be paying in the lease option is not mentioned in the question. It is included in the lease rental, so we cannot separate it from there. So since it is included in the lease rental there, so we have also included it here. Okay, the figure for third year, can anybody tell me the figure for second year? Sorry. For second year, it's 1960. What's the net figure for year 2? Okay, 10860. So it's minus 1960. Okay, thank you. The figure for year 3, it's again 23788 negative. For year 4, is it positive? 58948. Okay, positive. And for year 3, for year 5, 131660. Kindly do cross check the figures. Okay, now we need to pick up the discount factors. It's another thing that you need to keep. What discount factors we should be using? Uzair, the tax benefit for year 4. Okay, Uzair, I will explain it by the end of the question. Okay, what discount factor should we be using? Let's go back to the question first and listen carefully. We have been provided with two types of rates. One is 8.6% per year, which is the finance rate, the interest rate. And the second rate is the cost of capital, that is 11%. Now, everybody should remember one thing. Whenever we are taking a financing decision, we do not use the cost of capital. We use finance rate as our discount rate. Remember, we only use cost of capital for investing decisions. We do not use cost of capital for financing decisions. In case a question does not give us any finance rate, then we can use the cost of capital as our discount rate. But wherever a question gives us a finance rate, we'll always use the finance rate rather than the cost of capital. So we'll use 8.6% as our discount rate, but this is before tax. And we should always use after tax rate. So let's make it after tax, 8.6. The tax rate is 30%, so we have to deduct 30% from it, which means we have to take 70% of 8.6 to make it after tax. It's 6.02%. Now we know that our table will not be having 6.02%, and if we take 6.02% as our discount rate, it will put us in trouble because we have to calculate discount factors for every year. So remember, if we have a discount factor like this, we can always round it off to a whole number. That is, we can use 6% so that we can use our discount factor table easily. I hope everybody has got this. Should I go ahead? We are not taking 6.02 to make our life easier. So we are taking 6% as our discount rate so that we can easily pick the discount factors from the table. Hassan, we are taking 70% because we are deducting 30% from the cost of from the finance rate, because we'll be getting a tax relief on the interest payment as well. So we are not taking the whole of 8.6% as our cost of finance. We are taking 70% of the finance rate as our discount rate. For Manula, for financing decision, we do not take WACC as our discount rate. We only take finance rate as our discount rate for financing decisions only. Whenever it comes to investing decision, we will take WACC. Which figure, Sheila, you are talking about? Okay, do you mean 58948 is the wrong figure? Okay, what's the right figure? Can anybody tell me? I guess it's the right figure. Yes, it's the right figure, right? Okay, tell me the discount factors of 6%. Now we're taking 6% as our discount rate. Discount factors for year 1.943. Thank you, Sarah. 1943.890, 0.840, 0.792, and 0.747. Okay, now tell me the present values. Just calculate the present values. It will be 1 million for year 1, 98072. Do not forget to place the brackets for negative figures. It will put you in trouble when you'll be netting the figures. You may end up with the wrong calculation. So always put the brackets for negative figures. Figure for year 2, 1744 negative. Okay, thank you. For year 3, 19982 negative. For year 3, it's what about this? What about year 4? Four, 6,687, right? Positive. And what about last year? Nine, 8,350. Okay. Now add all these figures. Add the negative ones and subtract the positive ones. And tell me what's the value. Okay, it's 9,74761 net present value negative. It will always be negative, remember, because we are calculating the cost of buying the asset, so the cost will always be negative. Sunita, I'm coming with that. I'm just telling you about why we are taking the tax benefit. Let me first discuss the net present value of the project. So it will always be negative, remember. We are comparing the cost of the two options, so it will always be negative. So the buying option will cost us 9,74,461 in present value terms. So we'll compare the same with the cost of leasing the asset, and we'll decide on the basis of that. Sunita, as far as your question is concerned, why are we charging tax benefit on license fee? Because license fee is an operating expense, and tax authorities will allow this tax expense to reduce our tax. Since this license fee will reduce our tax, so we must consider the tax benefit that it is giving to us. On one side, we have to spend more by paying the license fee, but on the other side, it will make us pay less tax. So we have to consider both the cost of this license fee and the benefit of this license fee. Okay, let's move towards the leasing option now. It's very easy to calculate the leasing option because we can use NVT now here. Lease rentals, how much lease rental we were supposed to pay every year? Can anybody tell me how much lease rentals we were supposed to pay? It's 3,80,000, right? And it was starting from year 0, remember? So we have to pay 3,80,000 every year, negative. and it will start in advance means it will start from year 0 and it will end at year 3. 0, 1, 2, 3, 4, and you remember it's an advance annuity. So I have taught you the formula yesterday about the advance annuity, but we have another way of calculating it. Can anybody tell me the annuity factor for 6% for year 3? Can anyone tell me the annuity factor? Don't tell me the discount factor, Aisha. Remember, we have to use annuity factor because this is annuity. We are going to pay 380,000 every year. Okay, it's for the year 3, right? Okay, 2.673 is for year 3. And remember, year 3 means 1, 2, and 3. Sum of 1, 2, and 3. But we have to pay it at point 0 as well. So our annuity starts from year 0, and this is for 1, 2, and 3. So we know that the discount factor for year 0 is always 1. So what we have to do is we have to add 1 for this 0 payment. So it will be 3.673. So the relevant annuity factor for the lease rentals will be 3.673. I hope everybody has got this. Any question? Any question? Okay, so this our lease rental will start from year 0. Okay, so we have to pay the first rental at point 0, then we have to pay it at year 1 end, then 2, then 3. So the 4 payments will be paid in this way. The 3-year annuity factor, that is 2.673, is actually the sum of year 1, 2, and 3. If we go to the annuity factor table and we go to the 6% column and year 3 row, we'll see 2.673. Remember, 2.673 is for year 1, is the sum of the discount factor of year 1, 2, and 3. But our cash flows also include the point 0 cash flow, 380,000. So the annuity factor does not include this 0 cash flow. So we have to add 1 as a discount factor for year 0 payment. So it will make our total annuity factor as 3.673. So 3.673 into 3,80,000. So just multiply 3.673 with 380,000. So we'll get the present value of the cash flows that will start from 0 and end at year 3. So what's the present value? 1395740. Okay, thank you. 5740. Okay. So this is negative, so we'll write the brackets. Yes, the sum of all the discount factors will be called annuity factors. Okay, now since lease rentals will also be allowed as tax expense, so it will also have tax benefits. So upon 3,80,000 will be given a tax benefit of 30% every year. So can anybody calculate 30% of 3,80,000 for me? Can you people calculate? Okay, it's 114,000. So I'll write 114,000. Okay. Now, Listen carefully. The very first lease rental is supposed to be paid at point zero. And since we pay tax in arrears, so the very first tax benefit will be given to us after 1 year. So if it's zero, the tax benefit will start from one because of arrears. So we are starting it from year one, and we have assumed that zero is the last year. Okay, so it will start from one. In some cases they started from year two, but it's more complicated, so I won't go into that why they start from year two. So just remember we have paid it point zero, and we'll start in arrears, and it will start after 1 year. So 1 to 4. So it's a normal annuity now. Every year we are going to get this benefit of 114,000. It will start from year one and it will end at year four. So it's a totally normal annuity. Just tell me the annuity factor of year four at 6%. 3.465. Okay, thank you. 3.465. 3.465. Okay, 114,000 into 3.465. Okay, it's 395. It's 395,010, and it will be positive figure. So just subtract this figure from here. We'll get the net cost of the lease option. It's 1,000,730. Okay, negative. So if we go back to the previous slide and see what was the NPV of the buying option, it was 9,74,761, and we have it 1,730,000. So if you were the one who's going to take the decision, what would have been your decision? Will you go for buy option or will you go for lease option? Yes, we'll go for buy option because it will cost us less than leasing. Therefore, we'll go for the buy option. That's all for the lease or buy. This is the previous slide. Was there? Yes, I will share all my details with you all, the YouTube channel link, my Facebook link, and my contact number. Taha, nothing is rotting. It's actually everything is as a concept. So it depends on how you take it. So well, it's a buying option slide, Nasser. Uzair, you can't say we should not go for it. Uh, we are not going to decide whether we should invest in this technology or not. We have just decided if we feel that we need this technology, we should go to buy it rather than leasing it. So we haven't decided actually we are going for this technology or not. We have only decided whether we should buy or lease. In case we know that this technology is good for us and we should go for it, then the best option will be to buy it rather than leasing it. So we haven't decided the investment part. We have decided about the financing part. Thank you, Amina. Tax benefit slide of buying option. Okay. Uh, Thank you, Aisha. Thank you, everyone, for the comments. Okay, there's a question in the past paper called Duo Company. Just search it on the Google. You'll get it. I don't remember the exam attempt. Just go and attempt the Duo Company. It's a very good question for investment appraiser. So in this, the asset replacement video is not on the YouTube channel yet, but in a couple of days it will be on the channel. This is the leader. Kulan, yes, I will cover the foreign currency risk. Well, we're not done with today. We still have 8 minutes. We'll be discussing the sensitivity analysis and sir, please repeat your four tax benefit again, amounting to 95536. Okay. Tax benefits. Where is it? Okay. 96563. So this is just answering your question. 96563, actually, the written down value at the end of year 3 was 421875. At the end of year 4, we will sell the asset and we will cover 1 lakh of the cost. So the tax authorities will not allow the whole of the WDV 421,875 as the balancing allowance. So first they will deduct the scrap value from 421,875. Then the rest of 3,21,875 will be allowed as balancing allowance. So they will allow this as a tax expense, as a tax depreciation for the last year, and on this they will give us 30% relief, that is 96,563. Okay, let's come to the sensitivity. This is a small topic, we'll just cover it. What is sensitivity analysis? See, well, we did a question of the PV company in which we had a positive net present value, remember? And since the net present value was positive and we decided to go for the project because the NPV was positive. But the positive NPV depends on different variables. For example, if a project has a positive NPV of say $30,000, I'm assuming it, a positive NPV of $30,000, and I ask you people whether a company should go for it or not, the answer will be a big yes, because it's positive. But this $30,000 positive NPV depends on different variables like sales volume. When you have calculated 30,000 NPV, you would have expected a certain sales volume every year. If the sales volume goes up, the NPV will be increased, so it will not be a worry for us. But in the same way, there is a chance that the sales volume may go down. And in case it goes down, it will reduce our NPV and it might make our NPV negative. So the net present value depends on the sales volume, and this is called a project variable. The sales volume will be called as a project variable. So if this project variable changes, it will change our net present value. In the same case, we might have expected a selling price when calculating 30,000, and this selling price might go up, might come down. If it goes up, it will increase the net present value, so it's not a worry for us. But it might go down, and this will reduce our NPV, and this will be a concern for us. Since selling price will also affect the net present value, therefore it will also be called a project variable. So all the components which we use to calculate NPV are called project variables, and change in the project variable will change our NPV. So we will be concerned about the change in our project variables. Now, we would like to see how much change in a particular project variable we can afford. The maximum change that we can afford in a project variable expressed in percentage form is called sensitivity of the project. Say, for example, if I ask you a question that how much fall in sales value will make this NPV zero, and you come up in and say, sir, a 5% fall in our sales volume will make this NPV zero. This 5% is actually the sensitivity of the project towards the sales volume or sales price, whatever. So if the 5% fall in selling price will make your NPV zero, it means the project is 5% sensitive with the selling price. What this information will help us in, we'll come to know that to which variable the project is more sensitive. So we'll be taking care of that variable in a higher priority than others. So a sensitivity is actually the percentage change in a variable that will make NPV of the project zero. It's the maximum change that a company can afford in any project variable. Okay, I'll repeat this, and I think we should continue this topic tomorrow with the calculation. I'll just make the background of this topic so that when we start tomorrow, you'll have the background. Say, for example, our price is $10 per unit, and at this price, with all other project variables being constant, we are getting 30,000 NPV. Say, for example, a 10% fall in this price will make the price as 9, and it will make the NPV 0. So a 10% fall in net present value, a 10% fall in the price has resulted in 0 NPV. It means that the project is 10% sensitive with the selling price. So all we have to do with sensitivity analysis is to calculate the percentage change in a project variable that will make the NPV 0, assuming all other variables will remain constant. So in tomorrow's lecture, we're going to calculate the sensitivity of project variables. Alian, you can ask questions by writing in the chat box. Okay, I'm giving you my contact number, and it's 00923212604033. If you are from outside Pakistan, and if you're within Pakistan, you can just use this number. And for international, yes, it's my WhatsApp number. You people can add me on the WhatsApp, and I'll try to create a WhatsApp group where we can discuss further things. Yeah, don't worry, I will have some rest. Sikandar, home assignment is go and solve do O company question. It's a past exam question. Just search it on the Google, you'll get it. Do O company. Thank you, Zirek. It's December 2007 attempt question. YouTube, youtube.com/Ejaz Khan EK. Tomorrow we will be discussing sensitivity analysis. We'll be discussing capital rationing, and we'll be starting cost of capital. Thank you very much, everyone. And if you people have any questions, I have written my number. You may feel free to ask any question, and we can discuss it anytime. Safir, there's a lecture regarding IRR on my YouTube channel, and then I'll be putting other lectures also on the YouTube soon. So keep viewing the YouTube channel. You will get very useful videos regarding F9. Thank you, Sheila. Thank you very much. Dania, yes, I will be discussing sources of finance, and I'll also be discussing hedging. Yes, Shiraz, you will. I don't know what do you mean by the updated? Do you mean by the slides that I have just filled? Uh, no, I don't think you will be getting this because the ink will be erased. You just go and solve the slides, and if you have any problems, you can contact me later on. Okay, everyone. See you tomorrow. Take care. Bye bye. Allah Hafiz.